Hello everyone. If we haven't met, my name is Andrew Sampson. I'm a financial advisor with Wild Wealth Management Group. Today I would like to share with you a simple trick that I use to help put risk in proper perspective, not only for myself, but for my clients as well. And that's what I'm going to show you today on this episode of Simple Money with Andrew Sampson. So let's go ahead and get started. What you're going to do is you're just going to draw a simple chart, just like I have here. On the right-hand side, you're going to have a negative. The further you move to the right, the larger the negative impact is to your objective. At the top, you're going to write probability, and the higher you go up on the chart, the more likely it is that this negative occurrence happens to your portfolio or to your objective. So it doesn't really matter what your objective is, but let's just say that our objective is to use some funds for whatever the goal is, and the goal is going to happen in 2020, okay? So we want to get to our goal safely and on time financially. Now, the risk we're going to talk about today is the stock market going down, measured by the S&P 500. So since 1980 through today, there's never been a year in which the stock market has not gone down. And on average, the pullback is 14%. So the probability of the stock market going down at some point during the year is very high. Now, if you are a retired investor and you're living off of your nest egg, and that nest egg is fully invested in, say, the S&P 500, knowing that there's a very high probability that those funds fall by 14%, the impact to those funds could be very high because we're having to sell while the investments are low. I hope that makes sense. Now, if you are high and to the right, this is a bad zone. We do not want to be high and to the right. The other three quadrants we can manage. This quadrant you avoid, okay? So what are some things we can do to mitigate risk? We cannot change probability of the stock market going down, but we can impact, right? So one thing you could do is make sure that dollars that you're going to need this year is not subject to the whims of the stock market. Stock market goes down, but the dollars I need this year are in cash. You should consider proper investments for not only this year, but next year and the year after, possibly 5 to 6 years into the future. You don't want those dollars to be gyrating with the ups and downs of the market. So if your investments are not invested in the stock market, your impact when the stock market goes down is very low, possibly none at all. Now, we'll talk about this in a second, but it is possible to have a positive impact from the stock market going down. Back to our retired investors, if there's dollars that are not subject to the stock market and the market goes down, our risk to our objective actually becomes how long it takes for the market to recover versus the risk that the market goes down. So just wanted to point that out. Now, let's say that you are not retired. Let's say you are a working investor in the accumulation phase. You're plowing money into your 401k, your Roth IRAs, and possibly even a brokerage account each year. Well, again, the probability of the market going down is very high. How do we move impact from way over here on the right to possibly even positive? Well, if the stock market goes down and I have the ability to save during those times, knowing that every time the market's gone down in the past, it has eventually recovered, I can then buy into the dips. And over time, what happens is I would have a positive impact to my objectives, right? So want to make this video as quick as possible. I do plan on making more videos like this. So do me a favor and go ahead and subscribe. Hit the bell button because that's how you're going to get notifications when I do put out the next video. And if you've done that, I'll see you on the next episode of Simple Money with Andrew Sampson.